The Chancellor of the Exchequer, the Right Honorable Rachel Reeves MP, has today officially announced that the autumn budget will be delivered on Monday, November 26, 2025. As we know, the OBR forecast in March that public sector net borrowing will be £37 billion higher than previously forecast over the next 5 years, primarily due to higher interest payments on the UK's national debt. As such, economists are predicting further tax hikes in the autumn statement to help balance the books. And finance expert Jasmine Birtles is sounding the alarm that there are some big changes coming this winter that will affect retirees, property owners, and investors. So here's a breakdown of the most talked about proposals. First up, inheritance tax. The government is looking to overhaul inheritance tax, including scrapping the 7-year rule, which allows us to give away assets free of IHT after 7 years. Next, pensions. From April 2027, unused pension pots and death benefits will be included in the deceased estate for IHT purposes. This means that estates will have to pay IHT on the value of these pensions, which could increase the average IHT bill by £34,000. According to HMRC data, the responsibility for reporting and paying any tax due will fall on the executors of the estate, not the pension provider. However, pension providers will need to share information about pension assets with the executors. So if you have multiple pensions and are the executor for someone else's estate, this could become a complex task. Remember, most pensions offer drawdown options where you can access your pension fund gradually over your lifetime. This can help reduce the risk of your estate having to pay IHT on a large pension lump sum. It also avoids triggering income tax, which is charged on the fund when you take money out. So plan your pension withdrawals gradually. There are also rumors that the government might scrap pension tax relief altogether. So watch this space. Third, property. There are 3 potential shakeups here. First, rental income could be subject to 8% national insurance contributions, NUTs, a move that could raise £2 billion for the Treasury. This proposal affects both individual landlords and those receiving income from overseas property. And fourth, pension tax relief. The government is exploring wider pension tax reforms, including switching to a flat-rate relief system, which could help lower earners, but would mean higher earners receive less generous tax relief. They're also considering a 0.25% annual levy on pension fund values. And they might scale back salary sacrifice schemes, which allow us to boost our pension savings by giving up a small amount of our salary. This could affect long-term retirement planning, especially for those in their 50s. So what should you do now? Well, don't panic, but do take some action. Avoid making rash decisions about your pension, especially if it could trigger income tax or affect your retirement fund. Review your estate plan, particularly if you use the 7-year gifting rule to reduce your IHT bill. Consider how the inclusion of pension assets in IHT might affect your estate, and explore options like trusts, life insurance, or other forms of gifting. Think about your property holdings and use online tools to model the impact of NIC and potential changes to stamp duty or CGT. While these changes are still being discussed, it's important to stay informed and seek advice if needed. The autumn budget could reshape how wealth is taxed and transferred in the UK. So staying informed and seeking expert advice now could help protect your finances later. Thank you for watching. Please remember to like, comment, and share for more updates.